A move that no one expected has just occurred, and the consequences may reshape the global financial system as we know it. China has dramatically reduced its holdings of United States Treasury bonds, a shift so significant that it has sent ripples through markets worldwide. The timing is critical. At a moment when America's national debt is climbing to historic levels and interest payments are consuming a larger portion of the federal budget than ever before, one of the country's largest foreign creditors is quietly stepping back. This is not a rumor or speculation. The numbers are documented, the trend is clear, and the message is impossible to ignore. In this video, we break down what China has done, why it matters, and what comes next. First, we examine the scale of China's Treasury sell-off. Over recent months, China has reduced its holdings by tens of billions of dollars, dropping from its position as the second largest foreign holder of United States debt to third place behind the United Kingdom. This marks the first time in more than 17 years that China has fallen out of the top two positions. The pace is accelerating, and each month brings new data showing further reductions. Second, we explore China's massive pivot toward gold. While selling American debt, Beijing has been buying gold at a record pace. Central bank reserves now show gold holdings at their highest levels in years, and this strategic shift sends a clear signal about confidence in the dollar. Third, we analyze the pressure building on the United States economy. National debt has surged past $38 trillion. Interest payments exceed $1 trillion annually, and the government faces growing questions about fiscal sustainability. When foreign creditors pull back, the cost of borrowing rises, budgets become tighter, and economic stability becomes harder to maintain. You will learn how these forces connect, why this moment is different from past fluctuations, and what the long-term consequences could be for American households, businesses, and global markets. This video provides the data many analysts overlook, the trends that reveal deeper shifts, and the implications that extend far beyond a single headline. By the end, you will understand why China's actions matter so much and what signs to watch as this situation unfolds. So stay with us until the end. The story is larger and more urgent than most people realize, and you deserve to see the full picture without confusion or noise. Welcome to our channel, where we break down global finance in simple and clear language. If you want more videos like this, make sure to subscribe and support our work. China's reduction of United States Treasury holdings has been steady and deliberate, spanning multiple years and reaching a scale that cannot be dismissed as routine portfolio adjustment. From a peak of over $1.3 trillion in holdings back in November 2013, China now holds approximately $700 billion as of the most recent data from September 2025. That represents a decline of nearly 47% over the past decade. The reduction has accelerated in recent years. Since April 2022, China's holdings have remained below $1 trillion and have generally trended downward each year. In 2022 alone, China divested $173 billion in American debt. In 2023, it sold another $50 billion. In 2024, the figure was $57 billion. Each year, the pattern continues. This is not a sudden panic. It is a calculated strategy executed over time. In March 2025, China lost its position as the second largest foreign holder of United States Treasuries when the United Kingdom moved ahead. By April, China had reduced holdings by $8 billion in a single month. By July, it had cut another $25 billion, the steepest monthly reduction in nearly 2 years. These numbers come directly from the United States Treasury Department and are tracked by financial institutions worldwide. The trend is consistent and the direction is unmistakable. Multiple factors are driving this shift. First, China is diversifying its foreign exchange reserves. Holding too much of any single asset, especially one tied to the currency of a geopolitical rival, creates risk. By reducing exposure to the dollar, China lowers its vulnerability to American monetary policy, sanctions, and economic volatility. Second, China has watched closely as other nations faced financial consequences from holding dollar-denominated assets. The freezing of Russian reserves after the invasion of Ukraine sent a clear message to governments around the world. Assets held in dollars can be weaponized. For a country like China, which faces rising tension with the United States over trade, technology, and regional influence, reducing reliance on American debt is a form of financial insurance. Third, the structure of global trade is changing. China is increasingly conducting bilateral trade in its own currency, the yuan, rather than relying on the dollar. As trade patterns shift, the need to hold massive reserves of American debt diminishes. This does not mean China is abandoning the dollar entirely, but it does mean that the country is preparing for a future where the dollar plays a smaller role in its economic strategy. Fourth, rising interest rates in the United States have made treasuries less attractive. When rates were near zero, holding American debt offered stability with minimal cost. Now, with rates significantly higher, the opportunity cost of holding treasuries increases. China can deploy capital elsewhere, whether in gold, infrastructure, or other assets, and potentially achieve better returns or greater strategic value. This shift also reflects broader concerns about the sustainability of American fiscal policy. United States national debt has surged past $38 trillion, with projections showing it could reach over 200% of gross domestic product within the next few decades if current trends continue. Interest payments alone now exceed $1 trillion annually, surpassing spending on Medicare and national defense. When the cost of servicing debt grows faster than the economy itself, creditors take notice. China's pullback is not happening in isolation. Other major holders have also adjusted their positions, though not as aggressively. Japan, the largest foreign holder, has maintained relatively stable holdings, but has shown signs of selective selling in certain maturities. The United Kingdom increased its holdings, but much of that may reflect accounting shifts rather than genuine new investment. What makes China's actions particularly significant is the combination of scale, consistency, and strategic intent. This is not portfolio rebalancing driven by short-term market conditions. It is a long-term repositioning based on geopolitical and economic realities. The implications extend beyond China and the United States. When a major creditor reduces its holdings, it affects global demand for treasuries, influences interest rates, and reshapes the dynamics of international finance. Markets are taking notice, and the consequences are beginning to unfold. While China has been selling American debt, it has been buying gold at a pace rarely seen in modern history. This is not a coincidence. It is a deliberate strategy to shift reserves away from dollar-denominated assets and toward a hard asset that holds value independent of any single government or currency. From 2022 through 2025, China has been one of the most aggressive buyers of gold in the world. The People's Bank of China reported adding gold to its reserves for 11 consecutive months through September 2025, bringing total holdings to over 2,300 metric tons, valued at $283 billion. That represents an increase of nearly $30 billion in value in just 1 month as gold prices climbed to record highs. China's share of gold in its total foreign exchange reserves has now reached a record 6.8%. Double what it was just a few years ago. This shift is part of a broader diversification strategy, but it also sends a powerful message about confidence in the stability of the dollar and American financial assets. Gold has always been viewed as a safe haven during times of uncertainty. Unlike currencies or bonds, gold is not subject to inflation, monetary policy changes, or government defaults. It holds intrinsic value and serves as a hedge against financial instability. When central banks increase gold purchases, especially at the expense of other assets like treasuries, it signals concern about the future direction of the global financial system. The timing of China's gold accumulation is significant. It coincides with rising geopolitical tensions, increasing trade conflicts, and growing questions about the sustainability of American debt levels. It also follows the freezing of Russian foreign reserves in 2022, an event that sent shockwaves through central banks worldwide. If dollar-denominated assets can be seized or frozen for political reasons, Then diversifying into assets like gold becomes a matter of national security. Other central banks have followed a similar path. According to data from the World Gold Council, global central bank gold purchases reached their highest levels in decades during 2023 and 2024. Emerging market economies, in particular, have been accumulating gold at a rapid pace, reducing their reliance on the dollar and increasing their holdings of tangible assets. This trend reflects a broader shift in how countries manage their reserves. The old model, in which dollar assets dominated reserve portfolios because of unmatched liquidity and stability, is being challenged. The new model seeks greater balance, more diversification, and reduced exposure to any single currency or financial system. For the United States, this shift has serious implications. When foreign governments move away from treasuries and toward gold, it reduces demand for American debt. Lower demand can lead to higher interest rates, making it more expensive for the government to borrow and service its existing debt. This creates a feedback loop. Higher borrowing costs lead to larger deficits, which lead to more debt issuance, which can further reduce foreign appetite for treasuries. The psychology of the market matters as much as the numbers. When investors see major players like China shifting away from dollar assets, it creates uncertainty. That uncertainty can spread, prompting other investors to reconsider their positions. In a market as large and interconnected as the Treasury market, even small shifts in sentiment can have outsized effects. Gold prices have responded accordingly. In 2025, gold reached all-time highs, breaking through previous records and continuing to climb. Strong demand from central banks, combined with investor concerns about inflation, currency devaluation, and geopolitical risk, has driven prices upward. This creates a self-reinforcing cycle. As gold becomes more valuable, countries holding large gold reserves benefit, while those heavily invested in dollar assets face relative losses. China's strategy appears to be positioning itself for a future where the dollar is less dominant. By accumulating gold and reducing dollar exposure, China hedges against potential currency risk and builds financial resilience. It also signals to other countries that alternatives to the dollar-based system are viable and increasingly necessary. The shift toward gold is not just about China. It is part of a larger global recalibration, one that challenges the assumptions that have underpinned international finance for decades. The United States is facing a fiscal crisis that grows more severe with each passing year. The numbers are staggering. Total national debt now exceeds $38 trillion. Debt held by the public stands at over $30 trillion, which is approximately 123% of gross domestic product. This represents the highest level of debt relative to the size of the economy outside of the immediate aftermath of World War II. The pace of debt accumulation is accelerating. In fiscal year 2025, total debt increased by $2.2 trillion. That works out to nearly $6 billion per day, $248 million per hour, $4 million per minute, or roughly $69,000 per second. These are not abstract figures. They represent real obligations that must be paid, and the cost of servicing this debt is rising rapidly. Interest payments on the national debt have surpassed $1 trillion annually for the first time in history. This is now the second largest category of federal spending, exceeded only by Social Security. Interest costs now surpass spending on Medicare, national defense, and virtually every other major government program. What makes this especially alarming is that interest rates remain elevated and are projected to stay high for the foreseeable future. The average interest rate on government debt has risen from 1.6% in 2021 to over 3.3% in 2025. If rates continue to climb or even stay at current levels, interest costs will consume an ever larger share of the federal budget. Projections from the Congressional Budget Office paint a grim picture. Under current law, debt held by the public is expected to grow far beyond any previously recorded level over the next 30 years. By 2047, debt could reach 200% of gross domestic product. By 2055, it could exceed 220% if additional tax cuts are enacted and spending increases continue. These projections assume no major recessions, no financial crises, and no unexpected shocks. If any of those events occur, the debt trajectory could be even worse. The annual deficit, which measures the gap between what the government spends and what it collects in revenue, remains above $1.8 trillion. Despite efforts to cut spending and increase revenue through tariffs, the deficit has not meaningfully declined. The primary drivers of the deficit are mandatory spending programs like Social Security and Medicare, which are growing as the population ages, and rising interest costs. Discretionary spending cuts, while politically contentious, have little impact on the overall fiscal trajectory because they represent a small portion of the budget. The political system appears unable or unwilling to address the problem. Congress has failed to pass comprehensive budget reforms. Lawmakers avoid making difficult decisions about entitlement programs, tax policy, and spending priorities. Each year, the problem worsens, and the options for addressing it become more limited. The consequences of inaction are severe. Rising debt levels can slow economic growth by crowding out private investment. When the government borrows heavily, it competes with businesses and individuals for available capital, driving up interest rates and making it more expensive for companies to expand or for families to buy homes. High debt levels also reduce the government's ability to respond to future crises. If a recession hits or a national emergency arises, the government will have less fiscal space to implement stimulus measures or provide relief. Finally, there is the risk of a fiscal crisis. This occurs when investors lose confidence in the government's ability to repay its obligations. If that happens, interest rates could spike suddenly, triggering a cascade of financial disruptions. Banks, pension funds, and insurance companies that hold large amounts of government debt could face losses, potentially leading to failures. The interdependent nature of global financial markets means that a crisis in the United States would have international repercussions. Given the dollar's role as the global reserve currency, a loss of confidence in American fiscal management could destabilize markets worldwide. While such a crisis has not yet occurred in the United States, it is not without precedent. The Eurozone experienced debt crises in the early 2000s. Countries like Greece, Spain, and Italy faced soaring borrowing costs, economic contraction, and severe austerity measures. The United States has structural advantages that those countries lacked, including control over its own currency and the deepest capital markets in the world. However, those advantages are not infinite. If creditors, particularly foreign governments, continue to pull back from Treasury markets, the risk of instability increases. The International Monetary Fund has stated that the short-term and medium-term risk of a fiscal crisis in the United States remains low. However, it also acknowledges that the long-term trajectory is unsustainable. At some point, if current trends continue, the risk will shift from low to moderate to high. When that happens, it may be too late to implement gradual reforms. Instead, harsh measures could be imposed suddenly, with severe consequences for the economy and the population. The time for action is now, but the political will to act remains absent. When these three forces are viewed together, a troubling picture emerges. China is reducing its holdings of American debt, buying gold at record levels, and signaling a strategic shift away from the dollar. At the same time, the United States is accumulating debt at an unprecedented pace, with interest costs soaring and no clear plan to reverse course. These are not isolated events. They are interconnected forces that reinforce one another. China's pullback reduces demand for treasuries, which puts upward pressure on interest rates. Higher interest rates increase the cost of servicing American debt, which worsens the fiscal situation.
A worsening fiscal situation raises concerns among other creditors, prompting further reductions in Treasury holdings. The cycle feeds on itself. The shift toward gold adds another layer of complexity. When major economies move away from dollar assets and toward hard assets like gold, it reflects declining confidence in the stability and reliability of the dollar-based system. This erosion of confidence is gradual, but it is real. Over time, it can lead to a multipolar reserve system in which no single currency dominates. The implications are profound. For decades, the United States has benefited from the dollar's status as the world's primary reserve currency. This status allows the government to borrow at lower rates than would otherwise be possible. It gives American
companies advantages in international trade. It provides the Federal Reserve with unique tools to influence global financial conditions. If that status erodes, those benefits diminish. The cost of borrowing rises. Trade becomes more complex. The government's ability to manage economic shocks weakens. These changes do not happen overnight, but they accumulate over time. What seems like a small shift in 1 year can become a significant transformation over a decade. Right now, the trends are moving in the wrong direction. The combination of fiscal irresponsibility in the United States and strategic repositioning by major creditors like China creates a dangerous dynamic. The balance that kept the system stable for decades is becoming thinner. The pressures pulling it apart are growing stronger. This does not mean that a collapse is imminent. The United States still has significant economic and financial advantages. The dollar remains the dominant currency in global trade and finance. Treasury markets are the deepest and most liquid in the world. American institutions are backed by strong legal frameworks and a long history of stability. However, those advantages are not guaranteed to last forever. If fiscal policy does not change, if debt continues to grow faster than the economy, and if major creditors continue to reduce their exposure, the foundation of American financial dominance will weaken. The consequences would extend far beyond government balance sheets. They would affect interest rates for mortgages and business loans. They would influence stock market performance and retirement savings. They would shape the global economic order for decades to come. The question is not whether these forces are at work. The data confirms that they are. The question is how quickly they will unfold and whether policymakers will act before the situation becomes unmanageable. There are key indicators that anyone can follow to understand where the economy is heading and how much stress is building beneath the surface. Tracking these signals provides early warning of shifts that could affect personal finances, business decisions, and investment strategies. First, monitor China's Treasury holdings. The United States Treasury Department releases monthly data on foreign holdings of American debt. When China's holdings decline month after month, it shows a sustained trend rather than a one-time adjustment. Watching these numbers over time reveals whether the sell-off is accelerating, stabilizing, or reversing. Second, pay attention to gold prices and central bank buying activity. The World Gold Council and various financial news sources report on central bank purchases. When gold prices rise sharply and central banks, particularly in emerging markets, increase their reserves, it signals growing concern about currency stability and geopolitical risk. Third, track interest rates on government debt. The yield on 10-year Treasury notes is a key benchmark. When yields rise, it means the government must pay more to borrow money. Rising yields can indicate reduced demand from foreign or domestic buyers or expectations of higher inflation. Fourth, follow the national debt and interest payment data. The Treasury Department publishes daily updates on total debt, and the Congressional Budget Office provides long-term projections. When interest payments as a percentage of total federal spending continue to climb, it shows that debt service is consuming resources that could otherwise be used for programs, infrastructure, or deficit reduction. Fifth, observe statements from major economic institutions like the International Monetary Fund, the World Bank, and rating agencies. These organizations regularly assess fiscal health and issue warnings when they see unsustainable trends. Downgrades in credit ratings or shifts in economic forecasts can signal growing concerns about fiscal stability. Sixth, watch currency movements. The dollar index, which measures the value of the dollar against a basket of major currencies, provides insight into global confidence in the dollar. When the dollar weakens significantly, especially during periods of market volatility, it suggests that investors are seeking alternatives. In this environment, a few practical steps can help individuals and businesses reduce financial risk. Diversifying savings and investments is one of the most important strategies. Relying too heavily on any single asset class or currency exposes you to concentrated risk. Spreading investments across different assets, including some allocation to precious metals, foreign currencies, or inflation-protected securities, can provide a hedge against economic instability. Being aware of employment trends in your industry is also critical. Sectors that rely heavily on consumer spending, government contracts, or international trade may face greater risk if economic conditions deteriorate. Staying informed about layoffs, hiring freezes, or shifts in demand within your field can help you make proactive decisions about career planning or skill development. Following economic news regularly, even in simple summaries, helps you stay ahead of sudden changes. Major shifts in policy, interest rates, or international relations can have immediate effects on markets and personal finances. Understanding these changes as they happen gives you time to adjust rather than react after the fact. Maintaining an emergency fund is always important, but it becomes even more critical during periods of economic uncertainty. Having several months of expenses set aside in liquid, accessible accounts provides a buffer if income is disrupted or unexpected costs arise. Finally, if you have significant exposure to debt, whether through mortgages, business loans, or other obligations, consider the impact of rising interest rates. Fixed rate loans provide protection against rate increases, while variable rate loans can become more expensive as rates climb. Understanding your exposure and exploring options to lock in favorable rates can reduce financial stress over time. This is not about predicting disaster. It is about recognizing that the environment is changing and that those who pay attention to the signs will be better prepared for whatever comes next. Small signals often reveal larger shifts, and acting on those signals early can make a significant difference in outcomes. The signs explored in this video point to three powerful forces reshaping the global economic landscape. China's deliberate reduction of American Treasury holdings shows a clear shift away from dollar dependence. The massive accumulation of gold by central banks, led by China, signals declining confidence in traditional reserve currencies. And the United States faces a fiscal crisis driven by unsustainable debt levels, soaring interest costs, and a political system unable to address the underlying problems. Each of these forces matters on its own, but together they reveal a system under severe stress. When major creditors pull back, safe haven assets surge in demand, and fiscal sustainability is questioned, the foundation of the existing financial order begins to crack. This is not noise or speculation. It is the reality reflected in official data, central bank actions, and long-term projections. The implications extend to every household, business, and investor. Higher interest rates make borrowing more expensive. Reduced foreign demand for treasuries puts pressure on government budgets. Shifting confidence in the dollar affects trade, investment, and economic growth. Understanding these connections helps you see the larger picture and prepare for the changes ahead. If you found this breakdown helpful, make sure to hit like and subscribe to our channel. We will continue tracking these developments and bringing you clear, simple explanations of the stories that truly matter. The world is changing, and those who understand the forces at work will be best positioned to navigate what comes next.